Welcome to Investors Insights, where today's topic is September blues. So a lot to talk about today. I'm going to talk about interesting performance going on in the technology sector. Ty's going to talk about the consumer. Again, the consumer is 68% of the economy. It's very important. But first, Trey, August was a volatile month. We're going into September. September is usually one of the worst months. Give us an update on September.
Yeah, absolutely. So this really isn't any new news, but it does have a pretty strong track record. You can see on this chart that going back to 1950, September is by far the worst month for the stock market. Both on average and the median return are both negative. It's the only month of the year with both the negative average and median return. It also has the lowest positivity rate, which means only 43.8% of the times is the market up in the month of September. There's a lot of disagreement around why that is. There's some thought that when people get back from summer vacations, they want to right size their portfolios, some trading goes on. There's also consideration that people use this as a good time to get their taxes in order ahead of the new year. And then there's a lot of talk around consumer spending picking up heading into the school year. So people kind of need to take the money out of the market to pay off any debts they got from vacation, and then also get ready for a school year in the fourth quarter to close out the year. So whatever the reason is, it does seem to be consistent, though, that it does produce lower than average returns. Now, this obviously isn't a guarantee of what's going to happen, but it does seem to be consistent and something we're worth watching, especially after we just got off of what's likely a very good Labor Day holiday.
Yeah, exactly. And we use this historical analysis in building our investment strategies. So we know historically September is pretty choppy. Also, we continue to see the impact of higher interest rates on the market. And one sector of the market I want to look at today is the technology sector, which has been really volatile over the past year. Historically, technology has been a sector that has underperformed in rising rate environments. As you can see in this chart, the blue line shows the 10-year Treasury rate. The orange line shows the technology sector strength. And as you can see, during the second half of last year and early this year, the technology sector exhibited relative strong inverse correlation to interest rates. We saw technology stocks traded down as interest rates moved higher, which has been the historical behavior in previous market patterns. However, as seen in this chart, the move in rates from the low threes to the low fours during May through July of this year, based on the U.S. Treasury 10-year yield, was uniquely accompanied by technology strength. So we saw that technology actually showed strength despite rising rates. And this was due to the enthusiasm around artificial intelligence. Problem is, as the enthusiasm around AI started to dissipate in August, we saw the tech sector underperform a bit as rate sensitivity returned. I show this chart as an example of how unique the past 12 months have been in the market, and how interest rates and artificial intelligence have changed certain aspects of the stock and bond markets. And so obviously we think that this will continue to cause overall market choppiness, especially in the tech sector. So something we're watching closely. And so Ty, we talked about September being choppy. We talked about technology sector being choppy in the overall markets. Talk about the consumer. Consumer is very important. Consumer spending. Give us an update with the consumer.
Like you said, consumer, makes up about 2/3 of the economy. So highly important to always pay attention. Back to school season is a great time to look and see at, how the consumer's doing. And interesting report is that 53% of back to school shoppers plan on using debit cards this year, compared to about 45% last year. Now we can get into a debate about, debit card, credit card. We'll save that for another day, but, credit card, the interest rates are up, credit card interest rates are up. And so, it's an interesting dynamic to see that a lot of people are choosing to opt for, just taking it straight out of their bank account with a debit card, as opposed to, going with the higher interest rate of a credit card. We got an interesting chart here about how people are spending their money since January 2020. And so spending overall is up about 19.5%. Led especially strong by the entertainment and recreation space and retail. Interesting to see that grocery and transportation are only 15 and 13% higher, so below the overall average. I know we've talked a lot here about inflation with gas prices and with food prices, but overall, grocery and transportation aren't up quite as much as some other sectors. And so, interesting to see how the consumer's doing and how they're adjusting to increased rates in life post-COVID.
Yeah, a lot going on. And so we hope everybody has had a great Labor Day weekend. As always, a lot going on in the markets and the economy. If you have any questions on anything you've heard about today, please give us a call, email us, call us. We love to engage with you. And we hope everybody has a great week. Thanks for watching.